entering the market in 2026, the traditional cost barrier to entry has essentially vanished. Operating expense ratios on core equity index ETFs have reached a historic low of just 3 basis points. But as fees have dropped, a different vulnerability has emerged. Standard market cap weighted index funds now carry a level of mega cap technology concentration that hasn't been seen in previous decades. Within the flagship S&P 500, just 10 companies now account for roughly 37% of the total index value. This means the index is highly sensitive to the technology sector. A regulatory shift or a sharp rotation in tech can pull down the entire fund, even if the rest of the economy remains healthy. Building a resilient portfolio requires moving past a single index. You have to match specific investment vehicles to your timeline and your tax status. To navigate these choices, we categorize investors into 4 distinct personas: the young accumulator, the mid-career optimizer, the pre-retiree, and the simplicity seeker. The simplicity seeker is the hands-off investor. Their priority is a single fund solution that allows for fully automated contributions without any daily management. The young accumulator is focused on multi-decade compounding. With a long horizon to recover from market drawdowns, they generally maintain a high tolerance for equity volatility. In contrast, the mid-career optimizer and the pre-retiree must balance the need for growth with downside protection and tax efficiency as they approach their withdrawal phase. Identifying which persona fits your current life stage is the first step in determining which asset structures and risk levels are appropriate for your capital. There is a core mechanical difference between how these funds trade. Exchange-traded funds trade continuously on public exchanges, meaning their prices move all day. Mutual funds are priced only once per day at the market close, using the fund's exact net asset value. Mutual funds offer a behavioral advantage through native support for exact dollar investing. You can automate a transfer of exactly $100 per paycheck. While some brokerages now offer fractional ETF trading, it isn't yet a universal feature across all legacy platforms. Holding mutual funds in taxable accounts creates a capital gains trap. When managers liquidate securities, taxes hit remaining shareholders. ETFs avoid this using an in-kind creation process. Authorized participants swap stock baskets for ETF shares, bypassing liquidation and keeping the fund tax efficient. This leads to a standard rule for 2026. Use mutual funds for automated investing in tax-advantaged retirement accounts, but prioritize ETFs for taxable brokerage accounts. Market capitalization-weighted funds like VOO or SPYM allocate capital proportionally to market value. Consequently, the largest enterprises exert the most influence on your returns. In 2026, technology concentration has reached a historical peak. Within the S&P 500, the top 10 megacap technology holdings now account for approximately 37%. To reduce this concentration, you can use the Invesco S&P 500 Equal Weight ETF, ticker RSP. By giving every company an equal 0.20% weight, it shifts the exposure toward mid-cap and value factors. Another alternative is the Schwab US Dividend Equity ETF, or SCHD. It filters for companies with at least 10 years of dividend payments and strong balance sheets, serving as a defensive ballast during growth stock downturns. Furthermore, relying exclusively on US equities is a concentrated bet on one regulatory system and currency. International funds like VXUS provide broad exposure to markets outside the US at a low 0.05% expense ratio. A resilient equity core requires moving beyond the standard S&P 500, incorporating equal weight, dividend-focused, or international filters to balance out mega-cap tech dominance. For most portfolios, a standard intermediate bond fund like BND or AGG provides a yield of approximately 4.5% to help dampen equity volatility. These funds have an average duration of 5.8 years, introducing interest rate risk. If rates rise, bond capital value drops, causing temporary losses. To insulate capital, use short-duration government bonds like VGSH. With duration under 2 years, its value remains stable even when rates fluctuate. Selecting a bond allocation requires matching the fund's duration risk to your specific tolerance for price fluctuations. We can now map these structural vehicles into 4 portfolio blueprints designed for the personas we identified earlier. The Simple Global Core is a 100% allocation to VT, the Vanguard Total World Stock ETF. It provides a single position solution that covers over 10,000 stocks across developed and emerging markets. The aggressive 90-10 is designed for the young accumulator. It uses a mix of total market ETFs like BTI and VXUS for growth, with a small 10% allocation to BND to provide a minor buffer. The moderate 70-30 uses a dual duration bond strategy. By splitting the 30% fixed income sleeve between BND and the short-term VGSH, mid-career investors can capture growth while actively dampening volatility. The conservative 50-50 prioritizes preservation. It leans heavily on VGSH and dividend ballasts like SCHD to generate reliable income and minimize portfolio drawbacks for those nearing retirement. The objective of these blueprints is to align the mathematical volatility of the assets with your psychological ability to stay invested during a market correction. When you are ready to buy, use limit orders rather than market orders. During periods of high volatility, market orders can lead to slippage, where you pay more for the shares than the current quoted price. You should also select funds denominated in your local base currency to avoid the drag of foreign exchange conversion fees. Remember the rule for tax placement. Place ordinary income generating bonds in tax-advantaged accounts like an IRA, and keep broad market equity ETFs in your taxable brokerage. The primary advantage of this approach is behavioral. Automating your contributions through dollar cost averaging removes the emotional urge to time the market based on the latest headlines. Once you select your blueprint and automate execution, the most important step is to simply allow the mathematical mechanics to compound over the next decade.